you and Filippo and Sophia can decide together which one you
Okay.
want. Or if they want to do Lehman Brothers and you really want to do a report on insider trading, you can also decide to do one on your own. But those are the two options. And then in the second slide, I give you a little bit of background about the Lehman Brothers case. Okay. And so you see here, there's some information about what happened to Lehman Brothers. And then there are 3 questions that if you guys decide to do Lehman Brothers, I want to answer and prepare a presentation that addresses these 3 questions. So this is if you decide to do the Lehman Brothers case. And then if you decide instead that you want to do a presentation on insider trading, here is the information for the insider trading case. So there's a little bit of background. And by the way, we're going to talk today both about insider trading and the impact it has on the market and on the Lehman Brothers case. So you'll have some more information to decide. And if you choose to do this one, when you do your presentation, you need to make sure that your presentation answers these 3 questions. Okay, does that make sense, Leonardo?
Yes.
Okay, perfect. All right, very good. So let us begin. Let's go to the beginning and let's talk about what we are going to look at today in this lecture. So when we think of venture capital, private equity, starting a company, trying to get money to finance your company, all of these things, the starting point is the financial marketplace. And so today's lecture is really prepared to help you have an understanding of the international financial marketplace. When we talk about the stock market, when we talk about the bond market, currencies, commodities, all of these things together make up the financial marketplace. And it's really important when we prepare you to have a career in business, to start companies, to expand companies, that you have an understanding of how the financial marketplace works, because that's where you go in order to raise capital, to get investors, and so forth. So that's really the focus of our lecture today, is looking at different parts of the financial marketplace. So a logical place that we begin, even though we talk about the international or the global marketplace, we spend a little bit of time in this lecture today looking at the United States and the US financial marketplace, because it's one of the largest and it probably has the biggest influence on the other markets throughout the world. So we spend a little time talking about the US marketplace for that reason. Why is the American marketplace important, and why do we need to understand it if we're doing business in Europe or Asia or other places throughout the world? So in the United States, there are 2 of the biggest exchanges in the world, the New York Stock Exchange and what we call the NASDAQ. Okay. And what those markets do has an influence on Borsa Italiana, on the Hong Kong Exchange, on London. So we need to understand kind of how that operates. A second reason is, for now, and this has changed a little bit, there is the dollar, the American dollar, which is still the world's largest reserve currency. And so we look at most of the transactions, most of the big international transactions are conducted in dollars. In fact, oil is still traded in dollars. And so for that reason, we need to understand the currency market and the impact that the dollar has on financial markets. The central bank in the United States, the Federal Reserve, has a really strong influence on the Federal Reserve interest and impact on the European bank. So we, policy and the impact it has on the availability of capital in other market, the bond market in the world. So in summary, all of these things together we look at because they have a big influence on our own markets throughout the world. So the market structure in the United States is more or less similar to most Western democracies, most Western economies. But when we talk about the financial marketplace, what we're talking about is really many organizations and institutions that encourage the flow of money to investors and to borrowers. So when we hear somebody talk about the financial market, what we're talking about is the economy that is made available to companies, to investors, and so forth. And so the main parts of the marketplace are the Federal Reserve, but we also consider commercial banks, investment banks, insurance companies, mutual funds and pension funds, and credit unions. And we're going to very briefly just talk about which each organization represents. Okay. So the first we talk about is the Federal Reserve. And the Federal Reserve, the best way to think about the Federal Reserve is it's like the European Central Bank. It's an independent government agency that is responsible for carrying out the monetary policy and regulating the U.S. banking system. Okay. And so the Federal Reserve is what we call the lender of last resort, and it plays an important role in maintaining the stability of financial markets. And it operates in the same way as the European Central Bank. The European Central Bank makes loans to banks and financial institutions operating within the European Union to make sure that the banking system remains stable. This is really important as the kind of the starting point to understanding the financial marketplace. When central banks raise interest, it means that borrowing money becomes more expensive, and it means that it has an impact on startups, companies. You're a company and you need to go to the marketplace to borrow money. The interest rates set by central banks, the Federal Reserve, the ECB, and others have a direct impact on the availability of money for investment, for small business, for startups, and for private equity and so forth. So this is an important feature of our marketplace. When we have, we kind of stay with the banking system, and we have two types of banks really in the marketplace. We have what we call commercial banks, and we have investment banks. And commercial banks are relatively straightforward to understand. It's where you and I have our money. If we have a savings account at Intesa or another commercial bank, it's where we save our money, where we have our credit card. These are banks that accept deposits from consumers. They make commercial loans if you want to buy a house or buy a car. You borrow money usually from a consumer bank. They provide checking accounts, savings accounts, online banking. Mostly what we call commercial banks are retail banks that service consumers directly. people like you and I. The commercial banks are regulated by the central bank, and so they're regulated to make sure that they don't make risky loans, that your money in your investment is protected. This ensures the stability of the overall financial system. And then on the other hand, in addition to commercial banks, we have what we call investment banks. And these are important because investment banks are very important to startups, to private equity, to venture capital. These are institutions that provide services. They specialize in issuing securities. If you're going to take a private company and make it public, you would work with an investment bank to help prepare your initial public offering, your initial stock offering. These are also investment banks provide assistance if your company is being bought or you're going to merge with another company. Investment banks provide assistance with the process of mergers and so forth. Now, investment banks are usually operate outside of the central banking system. They're not insured by the federal government. These are considered more riskier investments, more riskier loans, because as we'll see throughout this course, most mergers fail, but investment banks fulfill a very important role in making sure capital and money is available who want to go public, who want to raise capital. So this is the investment banking side. Let me see, go forward. Okay, so in addition to commercial banks and investment banks, we have insurance companies. Insurance companies are a very important part of the financial marketplace. Why is that? Well, for two reasons. Number one, when we purchase insurance, we buy insurance for our health, life insurance, we insure our car, we insure our house, homeowners insurance. So the insurance company collects the premium, the amount we pay for insurance, and it creates a pool of money, okay? And what insurance companies must do with the money it collects from consumers, you and me, for our car, for our house, and so forth, they have to invest this money so that they will have money available for future claims. If somebody has an accident at their home and they make a claim, okay, the insurance company has to be able to invest the pool that it collects to make sure money is available when policyholders make a claim. Okay, so insurance companies are an important part of the financial marketplace because they have to become investors with the insurance proceeds that they collect. Then we have what we call mutual and pension funds. Mutual funds are basically funds that are available to the general public. So if you're an investment bank and you decide to create a fund, which means, you and I can buy into this fund. I want to invest 1,000 euros and I can invest in a mutual fund. And a mutual fund consists of a fund that's managed by a broker at the bank, and they decide how to invest your money. And in a mutual fund, there could be investments in 10, 15, 20 different public companies. And so the mutual fund is an investment in a fund managed by an investment bank that decides to invest your money across many, many possibilities in the stock market. Okay. And so then on the other hand, we also have pension funds. And pension funds are when a company, in the US, for example, a lot of companies have pension funds. That means as part of your wage, you qualify for the pension, which means every month you can say that a portion of your stipendio or your wage goes into a savings account or a pension fund for your retirement. And so these pension funds operate like this. The company collects a large pool of money of workers that are investing in their retirement. And so with these pension funds, companies have to invest this money so that money is available when workers start to retire. So these two, mutual and pension funds, provide the marketplace with a large amount of capital for investment. So these are important parts of the global financial system. And then we don't really have these in Europe, but in the United States, there are what they call credit unions. And these are nonprofit financial institutions that are owned and controlled by members. So they offer the same products as, say, a traditional bank. They offer checking, savings, loans, credit cards, and so forth. But they're not commercial banks because they're not for profit. If you have a company and all the employees decide to create a credit union, it means they've decided to pool all of their money together to create a credit union which functions like a bank, offers the same basic products as a commercial bank, but the difference is they don't make a profit. So these are also part of the financial system. So we've talked about all of the money that is used to invest when we have funds, mutual funds, pension funds, central banks, commercial banks, and so forth. We also have what we call the capital market, the place that we go to borrow money, to invest our money. And so we start this discussion first by looking at the US capital markets. Okay, so a capital market, we've talked about the financial market, which includes all of the organizations. Now we're kind of focusing in on the capital market. Okay, I'm a new business. I'm an investor. Where do I go to borrow money? To invest money. Okay, so sorry, Leonardo, we're back. We're back.
Okay.
Let me put the share screen back. Sorry about that. We
No
are going to
problem.
get this. We're going to get this situation with the internet fixed sooner or later. Okay, I lost you when we started our conversation about the stock market. So this is the place where stocks, shares in a company are bought and sold. Okay, and so this is an important feature of the capital market. We're going to talk a little bit more about that, but what we do in the stock exchange, okay, so the stock market, I'm a company, I'm Microsoft, and I want to sell my shares publicly, or I'm Nike, or I'm Amazon. I make my shares available for investors, okay? And so the stock market provides a platform where we discover the price. What is the price of stock in Google, or now in AI, companies that are startups that are investing in AI? So the stock market is important because the function of supply and demand sets the price for a share of stock. And this is really important because the more valuable a company is, the more investors want to buy their stock, the higher the stock price goes. Companies that are failing, that are looked at as being poorly run or with products that are not good, the stock prices are low. And so this is how the price for shares gets set. The stock market also provides for what we call liquidity, which is really important. Means that if I own stock, I have to, and I want to sell, I go to the stock market to liquefy or to sell my shares in a company in exchange for cash. So this is really an important feature of the stock market, provides for liquidity. A company needs to raise capital, so they sell their shares. The stock market allows them to do this. The stock market is also important because it provides a source of funding for companies. So I'm a new company or I'm an existing company and I want to raise money. I need to raise capital. I will issue shares of stock to sell. Or I'm a new company. I put my IPO, my initial public offering, on the stock market. It's a place where I can fund my company. And so this is an important feature of the stock market. It also provides opportunities for investors. Investors with these mutual funds or pension funds want to invest in companies, insurance companies who want to invest to make sure they have money. This is where they go, is to the stock market to decide to invest. And of course, the markets are regulated. The markets in Europe are regulated by the EU entity. The markets in the United States are regulated by the SEC, or the Securities and Exchange Commission. Now, the SEC is important because one of the homework assignments you guys have is on insider trading. The SEC, for example, as we're going to see, has very strict rules. If you work for a company, for example, and you have secret information that the company is about to make an announcement that will increase the price of its stock. For example, I'm a company and I know that I was just awarded a patent for a brand new product that hasn't gone to the marketplace yet. But I know that once the announcement is made, investors will come and want to buy stock in our company because of this new invention. So I have this secret information, nobody else has it. I decide to go to the marketplace and buy a bunch of stock with the price low, knowing that tomorrow when we announce this new patent, the price of our stock is going to increase very quickly. I buy the stock when it's low because I have insider information. The SEC and obviously, many European companies call this insider trading. It's a crime and it's not allowed because I've used secret information to enrich myself, but no other investor had this information. So this is one of the problems, one of the two problems, but this is an example of how the government regulates the stock exchange. So in addition to the stock market, where investors decide to invest in companies and companies decide to issue new stock or new shares, we have what we call the bond market. And the bond market is different, but it's complementary. It plays a complementary role to the stock market. So what does the bond market do? In the stock market, you're selling an ownership interest in the company through shares. We're saying, if you buy this share, you own a portion of our company. The bond market is really different because what we're doing in the bond market, I'm saying, if I'm a company, for example, and I issue bonds, or, it's basically, I'm asking to borrow money. Now, governments usually governments, cities, municipalities, and corporations will issue bonds to borrow money. And so basically, you buy a bond from the government or from a corporation, and I agree to hold this bond. Say it's a 5-year bond, okay? And so you issue the bond, which means you're borrowing money from me. What I promised to do is, in a 5-year bond that I've issued, I agree to pay you periodically a return to pay back the money with interest. So bonds can be 2%, 3%, 5%. It depends on the duration, but the bond market is basically, I'm loaning you money and you're agreeing to pay me back over a period of time. And if it's a bond with a 5-year maturity, it means I've agreed to pay you back in 5 years plus interest, whatever the interest is, okay? And so basically, this is considered, the bond market is a secondary opportunity for investors to protect their investments, to invest in safer investments. The obligation is to pay you back, as opposed to invest. Can make safer, less risk investments. And it's also a way for governments to raise money if they want a public building, a hospital, a school. They can use bonds to borrow money in order to do this. And corporations can use bonds to raise money for, for whatever they want to do. So the bond market really operates in a complementary way to the stock market in the global financial system. So bond markets, as we said, they're less risky. They're basically a way to, if I'm an investor and feel like, I have too much of my money in the stock market, I need to have some safer investments. Use it as an investor to manage my risk, okay? And the bond banks, the Federal Reserve, for example, right now, the interest rates are historically high because most in Europe and in the United States, we're trying to fight inflation. So we're raising the cost of borrowing because we're trying to take money out of circulation so we can bring down inflation, okay? So the bond market is important because it gives investors a way to basically hedge or protect against interest rate risk, okay? So the bond market also plays a very important role in helping investors to increase or decrease. It's a way that I can balance portfolio and investment. And lastly, it's an important source for governments to raise money. It's a way for them to borrow money at lower cost to help governments manage budget deficits and economic growth. So another market that's important to understand, particularly in today, the commodities market is a market Thank you for your patience, Leonardo. I'm sorry. It's little, I think it's the rain that's interfering with the,
Yeah, I think
yeah. Okay, so the commodities market, this is really important, particularly today. The commodities market operates separate from the stock market and the bond market. And this is an important platform because the commodities market is where the buying and the selling of raw materials such as food, agriculture products, energy, and oil. Oil is probably the most well-known example of a commodity. OPEC, for example, commodities are traded on the commodities market. Okay, and so one of the biggest commodities market is in the United States, in Chicago, in New York. And this is where the price of oil for a barrel, for example, is determined by the operation of buyers and sellers in the commodity market. Okay. And so what is the impact? So governments that have economic policies, the impact of the US economic policy tends to have a very big impact on the global financial marketplace. Okay, because the US economy is one of the largest in the world, it's closely watched by other governments, other markets, and other investors. So if you were in Europe thinking about maybe starting a company, buying a company, merging, of course, you'd look at the European Central Bank and say, what are the interest rates right now? But all investors pay very close attention to what the US marketplace is doing, because that will have an impact on our market. If the value of the dollar is increasing, it has an impact on the value of the euro. If the Federal Reserve is lowering interest rates, it'll have an impact on the European Central Bank, which usually follows closely what the Federal Reserve does. And so it's important for all global market participants to look at the policies and follow them, because usually what happens in the US global marketplace is going to impact the rest of the world. The Lehman Brothers, for example, that's one of the two possibilities you have for the homework assignment. When the Lehman Brothers company collapsed, and we'll talk about that in just a bit, it had an impact on other marketplaces. So if a major company collapses in the US, or there's a policy that is causing a bubble, it usually means that it's going to have an impact on other marketplaces. So for this reason, it's important that we as business people understand the importance and the impact of the US global marketplace. This, obviously, as we've been talking about, monetary policy, fiscal policy, is the US debt right now is increasing. It means that there's going to be a higher demand for goods and services that can boost the economy, or it means that it's going to encourage inflation. Similarly, trade policy. If the US starts putting a tariff on certain imports, it can make those products more expensive for other US consumers or businesses. In fact, you remember in business law, we talked about a trade dispute that's still going on more or less between Europe and the US right now over EV vehicles. The US has tried to establish preferences for American automakers with EV cars. Europe is saying that is having an impact on European producers and their ability to sell their goods in the US marketplace. So this is an example where trade policy is really important. If you had a business in the European Union that maybe manufactured parts for an electric vehicle, you would be impacted by trade or tariff policy in the US. And so these are some of the things why we want to make sure we fully understand the US marketplace. So kind of just some final comments on the overall financial marketplace. So we really kind of want to think of the global marketplace as one that is interconnected. The American influence is significant, but the marketplace is interconnected. What happens in America has an impact on the EU, is impacted by Asia, but the important thing is to understand that the marketplace is interconnected. This is important because when we see some of the disasters that happen with companies, it has an impact beyond the borders of the country where the company is operating, okay? And it's also a very complex system. It's a system that not only is interconnected, but has many, many different organizations that together comprise the financial marketplace. So we also have governments or international organizations that have an influence in the global marketplace. We are not going to spend a whole lot of time on this, but remember in business law, we talked about these organizations. These are also very important international organizations that play a role in the global financial marketplace. For example, we have the International Monetary Fund, or the IMF. And this is an organization that assists governments that are maybe having a problem with their currency. The IMF will come in and make a loan to a government to help stabilize a currency. So this is an important part, an important member of the international global financial system, because if a currency collapses, it has a chain effect and impacts other entities. So the IMF is an important player in the international marketplace. Similarly, the World Bank is also important because the World Bank specializes in providing loans to countries who want to start capital programs and technical assistance. So, for example, if I'm an African country and I want to build a road or build a bridge or build a hospital, the World Bank will lend my government money for this purpose. It's usually a very favorable low interest loan. But if I'm a company doing business in Europe, maybe I'm a construction company, or maybe I supply products that are used in building hospitals or bridge. I want to understand what the World Bank is doing and who it's loaning money to, because maybe I want to see if I can participate in a construction project and sell my goods, sell my services to governments that are launching these kinds of projects. And then finally, again, we talked about this in business law, we have the World Trade Organization, which plays an important role in trying to encourage free trade between countries and also providing a mechanism for where countries can go to resolve their policy disagreements and trade disputes that encourages free trade, which is again is an important part of the flow of capital, the flow of investment across countries, to stabilize the financial marketplace. Foreign exchange markets are really important to understand because this is the platform for buying and selling of foreign currencies. Okay, this is an important part of the international marketplace. So I'm a European company. I have euros, but I have to do business in dollars, or I have to do business in the yuan or the yen. I have to have a place where I go in order to exchange currency, to sell euros for dollars, to sell dollars for yen, I go to the foreign exchange, which is really important. And so every day, the Forex or the Forex markets, what we call the foreign exchange markets, are a critical role in the financial marketplace, because every single day in the Forex markets, what we call the foreign exchange markets, the volume of trading is over 5 trillion, over $5 trillion US, which is astounding, which means every day, in order to invest in companies, to buy stock, to sell bonds, any type of financial transaction, the Forex markets are like the glue that make this work. And every day over 5 trillion is traded in the Forex market. Okay, so what are the Forex markets? Well, we have what we call the spot market, where you would see the spot market if you're on vacation in a foreign country and you walk by an exchange booth. This is probably the best example of the spot market. Means I need to exchange $100 today for euros. I go to the spot market or an exchange booth. And what that means is I'm exchanging my money, what we say, on the spot for the current price. Okay. Same for businesses. If a business has a daily need to exchange, to do a daily transaction, they go to the spot market and they exchange for whatever the current price is today. That's the spot market. But we also have what we call the forward market, which is important because sometimes I'm a trader and I make an agreement to buy or sell a specific currency for a specific price at a future date. This is kind of a form of hedging. It's a form, I say, all right, I will agree to sell you in 2 weeks 100 euros at this fixed price. Okay, we call that a forward market because I'm making a promise today to sell in the future for a fixed price. And why am I doing this? All right, I'm an investor or I'm a trader, and I'm saying I think the price is going to go up or go down. And so I'm going to fix this price in the future as a way of maybe trying to reduce my risk. Okay, so the forward market is a place where buyers and sellers exchange. We also have a futures market. And in the futures market, for example, is very similar to the forward market, but here we have a standardized contract. It's a more regulated market where I'm going to, trade in a regulated exchange for a specific price in the future. But more or less, the futures market functions in the same way as the forward market, although it's just on a more regulated, more controlled exchange. Then we have what we call the swap market, which is interesting, which is where traders exchange a currency for a specific rate, and then I exchange them back at a later date. So for example, I say to you, I have $100. Today, I will exchange with you $100 for 90 euro, okay? And then part of my agreement is this is my exchange today, and next month on this same day, I will agree to exchange back the money I borrow. I'll give you the 90 euros for $85 or 110, whatever the rate is. And so this is a form of speculation where I am anticipating that the rate is going to go up or down. And so I'm agreeing to buy it today and then swap it for a fixed price in the future. And then we have the options market, which is I want to buy an option, which means today I would like to buy an option to have the right to purchase 100 euros next week for a fixed price. I'm not obligated to buy, but I want the option to buy. So I purchase the right to fix a certain price and buy, but I'm not obligated to actually make the transaction. This is a way that governments or businesses can protect their investment if they are fearful that the currency is going to move in an unexpected way in a short period of time. And then finally, we have the over-the-counter market, which is kind of like the spot market, where currencies are traded directly between two parties. So, this government and this government trade their currencies, or this company and this company decide to trade currencies. We call that the over-the-counter market. So as you can see, it's important to have a basic understanding of the Forex, or the foreign exchange markets, because they are indispensable for doing business in the global marketplace. And to kind of complete our discussion, this is kind of a structure for how the bond market actually works. So the international bond market, for example, we've talked about countries have bond markets. We have the international bond market. We have, this is a platform for where we issue and trade bonds that are in different currencies. So for example, the US, the Treasury Department issues bonds to finance its public debt. Okay, and then China decides to come in, which they've done, and they own a large portion of the American debt. They buy bonds that are issued by one country. Okay, and so the same in Europe, same in other places of the world. And so this is how the international bond market works. We have the foreign bond market, the euro bond market, and then global bond market. And so an overview of how all of these markets come. We have the financial markets, that we talked about. When issuing my initial public offering, the first time that I'm ever offering my stock, that's the primary market. After my stock has been issued, Microsoft, Amazon, Apple, companies sell their stock on the secondary market. Okay, then the Forex market, we see the various aspects of the financial marketplace. So this just gives you an overview of how everything together comes under the heading of the financial market. As I said, you see that this is complex. It has many different parts. It is interconnected. When something happens in the capital market, it usually has an impact in the other markets. And so it's also interconnected. And so this is kind of keeping the complex nature and the interconnected nature in mind. What I want to turn to now is kind of the problems and the financial crises, and what happens when we have what we call a financial crisis. Okay, so what do we mean when we talk about a financial crisis? We've talked about all of these parts have an impact or are connected to each other. In a financial crisis, what we see is that prices all of a sudden see a very sharp, a very steep decline in value. Okay, businesses or consumers all of a sudden can't pay their debts. And financial institutions like banks all of a sudden run out of money. They're considered no longer liquid. They don't have money to pay their obligations. So any number of ways this happens, we consider this a financial crisis, when there's a sudden change in market conditions, like a steep decline in the value of stock. This usually causes a financial crisis. And when this happens, when there's a steep drop in the value of stock, this sets off a reaction, because if I'm an investor and I see that the stock I own in a company is falling dramatically, what's the first thing I'm going to do? I'm going to sell my stock. I'm going to get rid of it because I don't want to lose all my money. So this sets off a kind of a panic amongst investors. They start selling off all of their assets. They withdraw their money from bank accounts. And so what happens when they start selling? That means companies have to pay, have to buy. They have to pay back obligations. If I take all my money out of the bank has to use its liquid assets to give me my money. And so it's creating a problem that circulates through the global economy. Okay. And so this is where we see stock market crashes. We see the financial bubble bursts. There's what we call the credit crunch, sovereign defaults, a country's currency collapses. All of these are examples of financial crises. Okay. So why are these significant? Why do we have to understand financial crises? Okay. The importance, and really this is what, in many ways, the assignment for next week is all about, is understanding why a financial crisis happens and how do we prevent this? How do we identify what we call the warnings so that we can develop a strategy to avoid the impact of a financial crisis? So we study financial crises because they help us prevent crises in the future. Okay. And so we're going to look at a couple of historical crises in just a moment. But if we understand what happens, like in Lehman Brothers, for example, there were many, many risk factors. There were many warnings that were very, very obvious to investors and to buyers in the stock market, but they were ignored. So if we can identify these risk factors, we can predict the likelihood that a negative event will happen, and we can take action to prevent them. This is really important. If we study a financial crisis, we can understand how the market behaves. If there's increased what we call volatility in the marketplace, if we see interest rates starting to go up, if we see certain behaviors that tell us we're starting to enter into a dangerous area, we can take preventative action to stop those from happening. We can also look at, with Lehman Brothers, for example, or insider trading, we can say in a prior crisis, we can say, could the government have prevented this from happening if the government had more oversight or more controls over investors? Could government regulation have stopped this from occurring? And financial crises also improve market efficiency, because when they happen, they show us where the marketplace was inefficient. And they show us that we're not properly managing risk because in this crisis, we learned that this was very, very inefficient. So by evaluating a financial crisis, they can help us to be more efficient in the future. And finally, we talk about market participation. A financial crisis is important because it gives those that participate, investors, borrowers, sellers, issuers, more information. And more information is always better to help investors manage potential risks. So let's talk, if we could now, about some of the financial crises that were really important from history that enabled us to learn from the situation, to put certain controls in place, and to make sure that certain things don't in the future. And the first one, and this is a crisis that shows the importance of the Forex markets, the commodities exchange, the need for governments to have stable currencies, and the importance of the IMF that lends money when governments are in 1997. This was called a financial crisis. And what happened? In July of 1997, Thailand, the Thai government ran out of foreign currency. Okay? It wasn't managing the value of currency. It had not done a good job of balancing in its reserve. Foreign currency, the government could no longer support the exchange rate. The government was forced to what we call float the baht, which means by floating it, you peg the baht to the price of the value of the US dollar. Okay. And so the US dollar, as we said, is the most stable currency of the world, which has a stable value, but the baht could not support the value when it was paired or pegged with the US dollar. So what happened in that case is the currency collapsed immediately. And this set off, because this was one country, the crisis quickly spread to other Asian countries, which caused a recession. It also caused other banks and companies to default on their debts because it set off this chain reaction. So the Asian financial crisis shows how interconnected regions are. So if one government is not maintaining the stability of its currency, this set off a reaction throughout Asia, which caused a crisis. So this kind of shows you the impact of one government's failure to maintain a stable currency. Then we look at another financial crisis, and this is probably something that is closer to us that we remember, what we call the dot-com bubble of 2000. This was an interesting financial crisis because at the time, in the year 2000, what we had in the marketplace was the rapid growth of tech companies. Okay, tech companies were starting all over. This is kind of when Silicon Valley really started to grow. We had all of these companies that were starting, that wanted to be the next Microsoft, that wanted to be the next big tech company. And so what we had is, at the time, interest rates were low. It was easy to borrow money. And what we had is on Wall Street, in the global marketplace, we had all of these investors who wanted to get in and buy these stocks or these initial public offerings of these new tech companies. Okay. So what we had with this bubble was all of this speculation, all of these investors that wanted to invest in these new tech companies. And so what happens when all of this money is coming in, all of these investors want to buy, okay? All of a sudden, of these stock, these brand new tech companies, their stock is going up. The companies are not producing products. You had this excessive speculation. I'm a brand new company. My stock goes on the marketplace on the first day for $10 a share. Because of all this speculation, in a week, it's trading for $1,000 a share. And in the meantime, I haven't made a product, or I haven't been able to bring a product to the marketplace. So basically, what happens was all of this speculation, all of this money coming in. And then what happened? The bubble burst. Okay. The company started to fail because they kept borrowing, and they couldn't pay their debts. And so the crisis, basically, you had all this money coming in. The value got inflated too quickly. The companies had nothing to sell. And so basically what you had is a complete collapse of the venture capital market. Okay. The venture capital investors, basically encouraged by greed, caused this, they adopted this reckless approach where I say, I'm going to invest $1 million in a company that has no value, just because I think if I'm right and they become the next Microsoft, I'm a trillionaire. Okay. This reckless speculative approach, basically, that had no evaluation of the profitability of a new company, caused this massive bubble, the dot-com bubble, to burst. And what happened when the bubble burst, all these companies failed. And now all of a sudden, all of these investors lost huge amounts of money. And what happens to our financial market at that point? It means less venture capital money is available for startups. And now all of a sudden, we're in a recession. So this was the dot-com bubble of 2000, which was really caused by excessive speculation by venture capital investors. Okay, happened mostly in the United States, but the impact was to the entire global economy. Now we come to what we call the global financial crisis of 2008. This was probably the most severe global crisis since the Great Depression. Okay, this was significant, and this is important because this is directly related to your homework assignment. This is the Lehman Brothers collapse. So what happened? In a way, many of the same things that were present in 2000 were also present in 2008, which was excessive greed and speculation. Okay, so what happened? In 2008, we saw a situation where we came out of the recession of the dot-com crisis, and the economy returned to a period of strong growth. Interest rates were low again. And so basically what we had is a situation where, basically the housing market, banks and financial institutions decided to create what we call a subprime marketplace, where I'm a consumer. I want to buy a house, but I don't have very good credit. And so the bank doesn't want to loan me money in the mortgage market. So what these banks decided to do and these investment banks decided to create what we called the subprime market, okay? And the subprime market means they're going to loan money to riskier consumers, people that really can't afford to borrow. But since it's so cheap to borrow money because interest rates are so low, we're going to basically create this subprime marketplace where we're going to basically have relaxed lending and cheap credit, and we're going to loan all this money. And on the subprime market, we're going to have higher interest rates, so we'll make money. But what happened was all of these investment banks that got into the subprime market, that started investing in these subprime mortgages, okay, what happened was the market collapsed. Okay, all of these Bear Stearns, Lehman Brothers, they all invested as subprime lenders. They were lending money that was being used to loan, make mortgages to consumers, to others that were not good. They were risky investments. So what happened? They started defaulting loans, and that had an impact on the subprime lenders. Okay, all of a sudden they owned all this debt, and they became insolvent because of this chain reaction in the marketplace. Okay, and all of a sudden what we saw, some of the largest investment banks and financial institutions in the marketplace were so heavily invested in these subprime mortgages, they ended up failing. And the crisis immediately spread throughout the globe. It caused a severe recession. It caused banks to fail all over the world. And it meant that many governments had to step in and bail out banks. So it was a very costly, a very dangerous situation that really caused a crisis in the global financial marketplace. The Lehman Brothers collapse in particular is particularly important because it shows that an established institution got involved in very risky investments when interest rates were low, with very, very relaxed lending standards, and lost billions of dollars and failed. And so analyzing this particular situation is a really good way to understand the full impact of the global financial marketplace. And what this set off, the 2008 crisis, really is related to the Eurozone crisis of 2011. Because what happened in the Eurozone crisis, we remember that very well, and in 2008, as part of this kind of chain reaction, we saw the collapse of Iceland's banking system. Okay, the crisis began in 2008, and oh, basically, high debt and deficits in all of these countries really started reducing investor confidence. It increased the cost of borrowing money. And so what happened is there were sovereign debt defaults in many of these countries, which, thanks to Mario Draghi's leadership, The ECB, the IMF intervened, and we were able to manage through this crisis and navigate through this period. But the Eurozone crisis of 2011, really, we see elements of it today. And honestly, it started the origin of Brexit in many ways. Much of the Brexit issue was tied to the market volatility in the Eurozone crisis that happened in 2011. In the aftermath of the Eurozone crisis, many countries adopted what we call austerity measures for the bailout. In other words, in exchange for being given money to, to stabilize their currencies, these countries had to agree to very strict rules to reduce the amount of their public debt. So this was the Eurozone crisis, but again, this shows you the impact this has had on the global financial system as a whole. So where we are here, Leonardo, we're kind of at the halfway point of the lecture. Let's go ahead and take about a 10-minute break, and then we'll come back, and it's probably likely that we'll finish a little early, but let's go ahead and take a break, and we'll come back. It's 11:26. We'll come back at 11:36, 11:40, okay?
Okay.
I'll go ahead and I'll just leave this open. If we get disconnected, I'll connect us again.
Okay, so I remain inside the.
Yeah, you
Okay.
can go ahead and mute, and I'll come back in 10 minutes. We'll go ahead and take our.
Okay. Okay.
I'll see you in 10 minutes. Okay. Leonardo, let's go ahead and get started. Are you back with me?
Yes.
Okay, perfect. Before I start, let me just stop and any questions from the first part of our lecture, from any of the topics we discussed?
For now is very clear.
Okay, very good, very good. So let's let's kind of just continue our discussion of financial crises in terms of what are the future risks? What are the risk factors? So today, for example, when we look at kind of what's happening in the world, the global economy, we look at interest rates and things of
Yeah,
this
for
nature.
example, for how can we say we can consider like a bubble this
Exactly.
example. Yeah.
Exactly. Bravo. Very
It's the
good.
same, so it's the same word in English.
Yeah, we have a bubble where we have everything is getting it's not when you have like speculation, a bubble means that it's too
Yes.
big. It's too big and it's not real. It's going to
Yes.
burst. Like if you put too much air in a balloon, it's going to explode. And so we use bubble in this way to say we have too much money being invested, too much speculation. If it continues, it's going to explode.
Yes.
Very good, very good. So when we look at these risk factors, for example, if we have high levels of debt, why do we worry about if there's a lot of debt? If a government has a high amount of debt, for example, we can take Italy. What it means is that you have to borrow more money to finance your debt. If we have high levels of debt, it usually means that the cost of servicing your debt is going to increase. If interest rate goes up, if you're a country, for example, when interest is low, 1%, you're like, okay, debt's not good, but I can manage this because it's not going to cost me that much to borrow money. When interest rate increases, it really puts pressure on countries and governments that have high debt. It means that their costs go up. And the same for businesses too. If I'm a business and I've got a lot of debt because I'm trying to expand or I'm trying to reorganize and interest rates increase, it means my costs go up because I have a lot of debt. I have to borrow money. Now the cost of borrowing money is increased. So high levels of debt are always a risk factor for financial crises. Inequality. If we have a lack of purchasing power among large parts of the population, so if we're in a recession and most people can't afford new things, homes, products. So this causes instability because it slows the economy. If I'm producing, household appliances and all of a sudden we're in a recession and consumers can't buy, it slows the economy and it causes a chain reaction. We have what we call systematic risk. We've talked about the global system is interconnected. We have a systematic risk where we saw this recently when you remember Silicon Valley Bank failed earlier this year, and that set off an impact. All of a sudden, we saw Credit Suisse and others. So we have a situation where we call shadow banking, or this where we have a risk that failure in one institution, if one bank fails, it'll cause other banks to fail. So we have to be careful of systematic risk. So if a bank in Switzerland fails, is that going to cause a bank in the Middle East to fail, and then a bank in Asia, because all of these investors have money all over the world? And then, of course, the one that we know very well today is what we call geopolitical risks. We have the war in Ukraine, which basically caused many companies to leave Russia. We now have the war in the Middle East. So, we don't know what's going to happen with the production of oil, with other parts of the economy that are disrupted by regional wars, political instability. So we have political or geopolitical risks that also can cause destabilization to the financial system. And then finally, an emerging area is cybersecurity, which we really is a new threat that is got everybody's attention, because we have the digital economy now. Most of our economy is digitalized. And we look at cybersecurity. If somebody comes in and hacks into a system and tries to take control over parts of the marketplace that are digitalized, this is a big threat to the marketplace right now, because most of the global institutions that make up the financial marketplace are digitalized. And so cybersecurity is something that really offers a very new and could be a very dangerous threat to the global financial system. And we go to our next slide, which is, so those are kind of the risks and the threats to the financial system, and why we need to be aware of them. If we're a company or we're investing in new companies, we're buying, we're selling, we have to be aware of how the marketplace works. What are the signs, the warning signs and the risks, and how do I protect myself? So the final part of our lecture, I want to talk with you about what we call efficient market hypothesis, or EMH. EMH is a very important theory that investors around the world use to make decisions on whether to invest. And the EMH theory is one that helps us understand the marketplace. So what is the efficient market hypothesis? It is a hypothesis that basically says that share prices, in other words, the price of shares in the marketplace, the price of Apple stock, the price of Adidas stock, the price of AKAM, whatever you are in the marketplace that has public stock, that price represents all of the information that is available at any point in time. So the efficient market says the price at $100 a share, that represents all of the information that is available. So why do we need to know this? The reason why this efficient market hypothesis is important is that when we operate under the EMH theory, we assume that stocks always trade at their fair value. And we say this because the market is based on this principle, because we believe it's impossible for investors to purchase stock that is undervalued or stock that is overvalued. So this is kind of the beginning of the EMH hypothesis. And we're going to look at variations of this in just a moment. But basically, under EMH, we say that it is impossible to beat the market. It's impossible to make a better investment. And the only way to make money under the efficient market hypothesis theory is by taking on riskier investments. It's important to understand this because investors all over the world follow and make decisions based on this EMH hypothesis. So we're going to take a closer look at this efficient market theory. So where did it come from? You know, kind of with the Industrial Revolution, which was the origin of the modern economy, we kind of look back to the 1900s. There was a French mathematician, basically, who was trying to offer an explanation for the marketplace, how prices are set, why investors make decisions that they do. And basically, his theory was that stock prices followed a random pattern, and you couldn't predict the price of a product based on the past. So just because the price was $5 a share yesterday doesn't mean that you can predict the price tomorrow. And so his theory was basically, this first generation was basically prices are random. And then in the 1960s, the theory was further changed, where this concept of market efficiency was added to the randomness, basically saying it was impossible to beat the market. It was impossible to know what the market would do before the market actually did this. And he proposed basically what we know to be the modern day version of efficient market hypothesis, which are three variations called weak, semi-strong, and strong. And we're going to take a deeper look in just a moment. And so by the 1970s, we had certain criticisms appear over this idea of market efficiency, basically saying that, you know, markets can be manipulated, there can be insider trading, there can be behavioral bias that certain people have, and all of these things make markets inefficient. Okay, and so this is now a competing idea of why people make the decisions they do when they decide to invest in the marketplace. And so in 2000, we saw what became this emerging theory that some investors, not all, but some in the world, are following, called behavioral finance, trying to understand the biases and the behavioral preferences of investors in order to decide what to invest in. And so basically in the current marketplace today, we still have EMH, efficient market hypothesis, continues to be a topic that is considered to explain why people decide to make the investments that they do. And so it's important that we understand kind of the basis of these for how decisions are made. So let us take a closer look at the three basic forms of efficient market hypothesis. We have weak, which says under weak, we can never predict the future price by analyzing the historical price. The semi-strong, which says prices adjust when new information becomes available. And then the strong, the purely strong, which says prices reflect all information that's available. Let's break these down a little bit more. Let's start first with what we call the weak form. If we believe, or if investors are following what's called a weak form efficiency, it says basically, if I believe in weak form efficiency, I say the price in the market is purely random, purely random. And it means that just because the price was 50 or 100 last week, it has no connection to what the price is going to be or today or tomorrow. So if I'm an investor that believes in weak form efficiency, basically I'm going to say all of the information that you could know about a certain stock price is reflected in the current price. Past information is completely irrelevant. And the key to this type of market efficiency hypothesis is randomness. So if I'm an investor, I say, I don't need a technical analysis. I don't need financial advisors or portfolio managers, because no matter what they analyze, it has nothing to do with the price. Prices are random. Okay. And so this is kind of the extreme example, but some markets, some investors follow the idea of weak form efficiency when they decide to invest. They say, this is random. I'm going to take a chance. You know, it's kind of like gambling. I'm going to hope that this investment becomes profitable. Okay. Then we have a middle version of this. We have what we call semi-strong form efficiency. And semi-strong form, I'm an investor and I believe in this, you know, the markets operate according to a semi-strong form efficiency. I am of the opinion that as soon as new information becomes available in the public, whether it's a new invention, a lawsuit against a company, a regional war, or something that becomes available, that the price will adjust immediately. Basically, prices respond immediately as soon as new information becomes available, because buyers and sellers react immediately, prices react immediately. And so in semi-strong, we're looking at current events and the impact current events are having on the prices today. But like weak form efficiency, a semi-strong investor doesn't really care much for technical analysis, because we think it's not very useful to predict a stock's future price, because whatever happens tomorrow is going to happen tomorrow. We can't know of it. So it's only what happens in the present that will impact price. And it's interesting on the semi-strong form efficiency, if you or you guys as a group decide to do the insider trading homework assignment, people who believe in semi-strong form efficiency basically don't believe insider trading should be banned, because basically insider trading can't affect stock prices, because if it's insider information, it's not known to the public, and because it's not known to the public, it can't have an impact on the price. So this is kind of another version of market efficiency. We say it's not exactly weak. We say you can't really predict the future, but prices will respond very quickly as soon as public information becomes available. And that's the only thing that can really impact the price of stock. And then we have a final one that's called strong form efficiency. And this is probably the most rigid version of the efficient market hypothesis. And under the third, what we call strong form, the investor believes that all information in the marketplace, all of it, whether it's public or private, is reflected in the price of the stock. So basically, in this type of strong form efficiency, insider trading or access to private information is also reflected in the stock and can't help an investor realize higher than normal profits or beat the market. Okay. Strong form efficiency believes that profits that exceed normal returns really can't be realized, regardless of the amount of research or information investors have access to. So these are kind of the three different forms. And, it's investors at different times kind of follow these three different hypotheses, but really at no one time is one the way to go. But this is a theory that has evolved that helps explain for investors how prices get set and how prices, may be anticipated in the future. Now, the marketplace still follows efficient market hypothesis, but there are pros and cons. There are positives and negatives to all of these versions, which basically, in all forms, we look at the pros and cons of this. EMH, or efficient market hypothesis, proposes that all the markets are efficient. It assumes basically that the price you're going to pay, whether it's weak, semi-strong, or strong, accurately reflects all of the information at any given time. It also, the pros of the EMH theory also assumes that markets are liquid. And what we mean by that, it means that I can buy and sell security at fair prices. I can have confidence that the price that's being set by the market is a fair price. And the price is reflecting all of the available information. I can trade quickly if I'm an investor. And so it's the concept of efficiency and liquidity that promote market efficiency. And so these are the positives of following the efficient market theory in investing. But there are also negatives, and critics of the efficient market theory have pointed out that there are limits because markets can be inefficient. Markets can be inefficient when there's manipulation, when somebody artificially sets a price high or low using insider information. If somebody like Warren Buffett has a certain bias or a certain preference for certain kinds of stock, and because he has the reputation he does, he makes an announcement that, Berkshire Hathaway is going to buy this stock in this company, that has an impact on the market because he has a behavioral bias that other investors will follow. Okay? And so these kinds of interventions, the critics point out, can make markets inefficient. And so, although, kind of the final point, although this efficient market hypothesis assumes that all investors, you and I are both investors working on Wall Street, under this hypothesis, it's assumed that we both have access to the same information and the markets are in balance. However, in the real world, we know that's not true. We know you could have different information than me, and we know that certain events can make the markets fall out of equilibrium. And so, as the critics point out, that there are limits to this EMH theory. So where does that leave us? Basically, at the end of the day, we have, reason for EMH. EMH provides us with an important framework for how we understand the marketplace. How do we understand financial markets? It helps us explain how the markets work, how prices are set, and how movements and volatility can impact the market. And we want to assume the positive aspect of the efficient market hypothesis is that for investors, and to ensure that the flow of credit continues through the financial market, we want to assume that prices are fair, that they reflect, the accurate value of a share or a price, which helps prevent market manipulation and insider trading. And then finally, we use the efficient market hypothesis because we want investors to make informed decisions. If we can have confidence that the price of Google stock, the price of Sony, or any other public company that's set by the market, if we assume that the price reflects all known information or of all available information, under the EMH theory, investors have a basis, have a reason to invest in a company with confidence and to justify their decision making. So these are the positives of the EMH theory for investors, to kind of have an assumption that basically the price set in the marketplace is generally correct. It reflects the value of a company, and investors should have confidence that that value is correct. It helps promote the flow of capital through the financial system. But of course, we have to acknowledge that there are limitations, and the critics to EMH point out that if we put too much faith in EMH, we are not recognizing that markets can be inefficient, that there can be manipulation, there can be insider trading, there can be biases that all impact how prices are set. In fact, we can go back to the dot-com bubble in 2000 and say, in that situation, we had all of this wild speculation by venture capital investors who were trying to get rich very quickly. They manipulated the market in a very negative way that caused the dot-com bubble to burst and the collapse. That's a good example of both behavioral and manipulation that impacted the market, because we know the prices that were being set for dot-com companies were way overvalued. Okay, under the EMH theory, they would have said, oh, that's not possible. But as the critics of EMH point out, we have to understand that market manipulation and behavioral biases can impact the marketplace. And similarly, EMH doesn't account for irrational behavior, the irrational behavior of investors. Now, here's a great example. Think of Elon Musk, who bought Twitter. Now, I guess it's formerly known as Twitter. Now we call it X. There were many people, in fact, this very theory, if you went and watched the business news when Musk was buying Twitter, most people say he overpaid the valuation of Twitter because he made an emotional, irrational decision. He decided to overpay for the value of what many analysts on Wall Street were saying. Twitter, the value of Twitter wasn't worth what Musk paid for it. That's a great example of kind of this emotional decision that somebody like Musk made when he decided to invest in a company. Most people agree he paid more than what the company was valued at. Now, time will tell whether this turns out to be a good investment, but that's a great example of the limits of EMH. Okay, and as we talked about, EMH doesn't account for the market bubbles. We assume that markets are always in equilibrium and balance, but then you have the dot-com bubble, and EMH doesn't help you understand or predict that. And finally, EMH doesn't really account for governments. When the government comes in and passes a new regulation, after the Lehman Brothers collapse, for example, the government came out with all kinds of regulations to restrict or prevent lending under certain circumstances, certain disclosures that all of a sudden make it more costly for businesses to operate. The efficient market hypothesis doesn't really account for government policies and rules that can really impact market efficiency. So this is kind of the pros and the cons. And so what does that mean for, what does that mean for us as those that need to operate in the marketplace? It means that we have to understand both. We have to kind of understand how both the pros and the cons work. So together we can understand what the influence is on the marketplace. And so when we look at how does efficient market hypothesis influence investments in the marketplace today, we can understand this in two ways, basically. We can understand this with the idea that there's active investing, and we can understand it with the idea that there's passive investing, okay? And so these two really help us understand, how are investors behaving? When we start talking about mergers and acquisitions next week, when we start thinking about if we have to go to the financial markets to raise capital or we're trying to invest, we want to understand, what is active investing? What is passive investing? And so let's start first with active investing. Okay. In active investing, this is a strategy where investors try to beat the market by selecting individual stocks and bonds they believe will perform better than the overall market. And these are your investors on Wall Street that are managing the funds. I think that this company, and this company are going to do better than their projected profits and earnings. And because of that, there's a technical analysis, and because of that, we have active investing. Under the efficient market hypothesis, active investors, unfortunately, cannot consistently outperform the market because prices are assumed to reflect all available information, making it difficult, if not impossible, to identify undervalued stock. But with active investing today on Wall Street and other financial markets, the investors are having this pros versus cons discussion every day. Active investors say, maybe we can beat the price of stock for a month or two, but in the end, I'm going to make an investment decision that, reduces my overall risk. So this is active investing. I'm trying to pick the stocks that are going to do better than what they're anticipating. Then we have what we call passive investing, okay? Basically, passive investing is a strategy in which investors basically, if we say the overall market is returning an average profit of 3% on shares, or the share prices are growing by 3% in this quarter, or 5% in this quarter. The passive strategy is, I don't want to beat the market because I know I can't beat the market, but my goal, if I'm an investor, is I want to have a diverse portfolio so that I can realize a return that's equal to what the market is performing at. And if the overall performance of the market is that stocks are increasing by an average of 3%, okay, as a passive investor, my goal is I am going to meet, that's my target, not to beat it, not to go higher, but my goal is to realize the return of the market. I can't do better than the market, but I want to match the performance of the market. And so, unlike active investing, the idea of EMH is more consistent with passive investing, because it is based on, passive investing is based on the idea that investors can't really outperform the market. We can't beat the market, but our goal is to match the market. So this is kind of the two schools of thought that exist in the marketplace: active investors, passive investors. It depends. You have to know, when you're deciding to invest. For example, your company wants to invest some of their reserves in a mutual fund. One of the things you're going to want to know is, what is the philosophy of the investors? If your fund is more into active investing, you're probably going to have riskier investments. You're going to have investors that are trying to beat the market. If you're in passive investors, probably more diverse portfolio with the idea that we're just trying to follow and match the market. We're not, trying to find the stocks that will outperform. So this is kind of the two ideas of investing. Again, when we kind of take a deeper look into, mergers and acquisitions and raising capital, we'll kind of return to these concepts in more. But for now, just kind of introducing the ideas. Just saying a couple final comments about the last part I want to talk about, and then we'll review the assignment together. We kind of looked at this when we looked at the timeline of the efficient market hypothesis. There is a new theory of investment, or relatively new, since like the 70s, this called behavioral finance. And behavioral finance is kind of interesting. It's a newer theory. Basically, behavioral finance is the idea that that combines economics and psychology. So if I'm into the field of behavioral finance, I'm going to take economics and psychology and put them together to try to understand how people make financial decisions and how those decisions can impact the marketplace. So basically, behavioral finance is a field that tries to explain why investors may deviate or might go away from what would be considered rational, reasonable, efficient market hypothesis. I'll go back to Elon Musk because he's such an interesting individual who is a true entrepreneur, who doesn't do things that most people would say would be expected. He breaks the mold in many ways. But if behavioral finance would look at his purchase of Twitter, they would try to understand what was it about Elon Musk's personality, his beliefs, his convictions, that led him to buy a company that most people say he overpaid for. And some might speculate, well, he really believes in free speech. He doesn't believe in government censorship. So he made a decision based on his political beliefs. Okay? So this is kind of an example of behavioral finance. Behavioral finance is just another tool. It's a tool that investors look to. It's a growing field. But at the end of the day, I think, it's really hard to speculate why a company may have a certain bias or motive or ideology. At the end of the day, most people will look at, kind of the business case, profitability, trying to make an investment that's going to yield a return. At the end of the day, this is just another tool that may help us understand certain transactions, but the majority of the market, investors are still kind of following kind of the concepts of efficient market hypothesis and either engaging in active or passive investing. So this is kind of where we are. And this last slide, basically talks about, behavioral finance, trying to understand, why people, stray from these rational decisions. Do they have some sort of bias, and so forth? Emotions, for example, such as fear and greed, may lead us to explain why certain market bubbles or crashes occurred. Behavioral finance, again, can be helpful as a tool, but it really can't be used to explain how the market works every day. It's just a discrete tool that will help us understand certain things. So all of these together give us kind of a basis and an understanding for the global marketplace, how financial markets work, where do businesses go to raise capital, where do they go to issue stocks, their initial public offering, where do they go to borrow money, how do these factors all interact with one another. These first two lectures give us kind of an overview of the marketplace where businesses operate. Now, next week, we're going to start looking at mergers and acquisitions. When a new company grows, it either merges with another company or it buys another company. So we're going to start exploring in detail how companies are bought and sold, how companies become, bigger, how they change, and in order to understand the process of M&A, we have to understand venture capital and private equity and how the markets work where they all must function. So these first two lectures give us a very important foundation to understand where venture capital, where private equity goes, and how mergers and acquisitions are conducted. So the assignment that we're going to do together for next week, Leonardo will go through this now in detail, and then I will send a summary to your colleagues that hopefully will help you guys make a decision for what will be due next class. So this first assignment, you have two choices. You can either decide to do your presentation analyzing the collapse of Lehman Brothers, or you can do the insider trading case. Okay, we'll talk about those in detail in just a moment. Okay, so what do I want you to do? I want you guys to prepare a 10-minute presentation that will address the questions that I've outlined on the slides we'll look at in a moment. So as part of the presentation, what I want you guys to prepare is maybe 5 or 6 PowerPoint slides that contain the information, the answers to the question that you're going to use to give the presentation. And the three of you should divide the presentation equally. So you each should take a portion of it to divide it equally. You can do an internet search. You can do a Google search. You can use ChatGPT, but use it under the policy that is in the syllabus. And you can ask me. You can come to me. Okay. And then at the end of the presentation, because we're a class of 3, I'm going to be asking some questions to you guys about the presentation. So part of this will be following up and answering the question. And you should be familiar with the format because we've used this in business law, for example. So you're going to be graded on the quality of the presentation, how good is the information that you've provided, and how you've explained the information in the presentation and answered questions. So these are the basic instructions for the assignment. So if you decide to do the Lehman Brothers case, basically what you had, Lehman Brothers, you do a little research on this company, which should be easy to find. This was a company that was started in 1847, and it had been in existence and grown for for years and years and years. And before it collapsed in 2008, it was the fourth largest investment firm in the US. So it had become a very big, very successful company. And on September 15th, 2008, Lehman Brothers went bankrupt, closed its doors, and failed. So I want you to research, okay, what caused it to go into bankruptcy. Now, in the early 2000s, before bankruptcy, Lehman Brothers became involved with what we call subprime mortgages, these very, very risky investments in mortgage-backed securities. So I want you to look at what were these investments that they were deciding to do and why. And this is what's interesting. You know, we can think of behavioral investing. Were they motivated by greed? But they made this decision to get involved in this very, very risky mortgage-backed securities, okay? So that's the background. There's three questions, and this works out great because there's three of you. And you guys can divide up the work however you want. Explain how this subprime crisis triggered the subprime mortgage investments. How did this cause the collapse of Lehman Brothers? And secondly, what caused the lack of liquidity? Basically, once Lehman Brothers failed, everybody ran to the bank to withdraw their money from Lehman Brothers before it ultimately collapsed. What caused this to happen? And third, final question, the Lehman Brothers collapse had an impact on the global financial marketplace. I want you guys to research and explain basically what was the impact. Did Lehman Brothers cause other financial institutions around the world to collapse? Give me some examples of how this collapsed. So these are the three basic questions that I want you guys to research. And if this is what you decide to present on, okay, this would be, and it's a very interesting, I think you guys would find this very interesting. So this is if you choose Lehman Brothers. Clear so far? Okay. The other possibility, okay, the other possibility is insider trading. There is insider trading is I work for a company or I own a company and I have information that nobody else has. And I decide to use this information to my advantage. And so in insider trading, as we talked about in business law, you probably remember, it's illegal in most countries. Okay. There was a big insider trading case by this man by the name of Raj Rajaratnam. He was the head of an investment group called Galleon. It was a hedge fund. It had over 7 billion in assets. And in 2009, Rajaratnam was convicted of a crime, the crime of fraud in insider trading. And he had to spend 11 years in prison. And this is a famous case because this is one of the biggest insider trading cases in history. And so if you decide to analyze this case, this is interesting because there is a debate amongst, legal scholars and ethical scholars over insider trading, okay? The first question that I want you to answer if you choose this case for the assignment is summarize the scandal. What did he do? How did he use insider trading to enrich himself? So first thing is to summarize the scandal. The second is to explain why insider trading is considered dangerous for the marketplace, and why most countries in the world, in fact, consider insider trading to be a crime. So this is kind of a interesting moral, ethical question that you guys can talk about and present. And then the final thing, which is kind of an interesting part of this assignment if you do it, is talking about the relationship between insider trading and the efficient market hypothesis. Okay. And in at least two of the efficient market hypothesis, the idea is that insider trading really can't impact the price. Now, whether that's true or not, it's up to you guys to give me your best opinion. And really, this is really to say, is it fair that if I have information that you don't have, that means I can go to the market and I can make money based on this information that you don't have the same opportunity? So it's kind of an interesting question to explore of, is it right that one side should have an unfair advantage? And if not, then insider trading, your opinion is yes, it should be a crime. Or maybe you guys can say, no, we don't think insider trading should be a crime for this reason. It's up to you, but the idea is to kind of think about, what insider trading does and whether you agree that this destabilizes the market and your reasons. So these are the two basic assignments. And so I will leave it to you and Filippo and Sophia to select which one you want to do. And then at the beginning of class next week, we'll start with your presentation. It'll be 10 minutes. And what you can do is the morning, I'll give you until the morning by the start of class. You can upload your PowerPoint to Google Classroom. Go ahead and just post it there. And then at the start of class, and then we'll review at the beginning of class next week. We'll review, I'll listen to your presentation and we'll talk about, what you decide based on your research. The idea for this assignment, Leonardo, is really kind of to find an interesting way to really look at a real life case and examine the impact that this had to the global financial market. So this assignment will give you an idea of how in the real world markets can be impacted based on these kinds of manipulations or situations. This will be very helpful when we go forward and we look at, money that's made available for venture capital and private equity. Clear so far?
Yes.
Okay. If you have any questions, let me know. You can send me an email, or we can set up a video call. Just let me know. I will go ahead and put a short post onto Google Classroom so you guys, just reiterate the assignment. Otherwise, I look forward to, I think you have some fun with this assignment. I think it's very interesting, and I'll look forward to seeing you guys next week. And I will probably, in the middle of the, by Friday or Saturday, I will post on Google Classroom, the lecture notes and material for the next lesson.
Okay.
Any questions before we break?
No, for now, no.
Okay, well, it's very good to have the chance to spend the morning with you as always. I wish you a good week, and I look forward to seeing you and hopefully your colleagues next Tuesday.
Yes.
Okay, Leonardo, take care.
Bye.
Bye-bye.
Good morning.